Reverse mortgages, are they risky or the ultimate retirement plan? This is what we're asking today. Hi, I'm Noor with Keller Williams, and this is
Milad with Mortgage Outlet, Orchid Financing, as a mortgage broker, and hopefully we're going to discover more about the reverse mortgage, which seems to be one of those niche products and services that's available within the mortgage industry as a whole, predominantly geared towards the more seniors, but is also, from what I gather, is not very known and popular. So we're going to talk about it.
We're going to talk about it, yes. But before we talk about this, let's find out. Tell us a bit about yourself.
About me. Beautiful.
And how you got into the mortgage.
Yes. So I graduated from Kingston University in London, United Kingdom. I've been in the finance industry since 2007, just before the financial crisis. It's been well over a decade that I've been in the finance, and I've done the majority of different roles, from private banking, affluent investment banking, commercial banking, and then I moved to Canada, and here I am. So as a mortgage broker, and I've been in the industry for the last since 2021. So it's not been too long, but it's also been great and very related to what I've done in the past in terms of the finances.
And we're very lucky to have you here in St. John, in New Brunswick. So tell us, what is reverse mortgage?
So reverse mortgage is a product designed for seniors in a sense that allows them to tap into the equity of the home without the burden of the monthly repayment. So your cash flow remains unimpacted, but you also get to get the equity out of your home. Now, one of the reasons we say seniors is because, as we said, you don't make a monthly repayment towards this mortgage. So the lender allows you, at best case scenario, to maybe tap into 55% of the equity of your home, and you only expected to pay that debt back plus the interest, God forbid, when you pass away or when you decide to sell the property. That's when the debt becomes, due back. And the higher the age ladder you are, of 60s and heading towards 70, the more of that funds you could get access to. So preferably, if you're a couple who have, who own a property that don't have a mortgage on it, and it has a value, of course, depending on the age, the property, there are lenders that would be looking to support you to take equity out of that home, and you could, invest it as you see fit.
So, if I were to do that, do I need to qualify? Do buyers need to qualify? And how does the process go?
So the qualification is pretty simple in a sense that, it will come down to A, you owning a home, B, how much equity is available in your home and what's the property of your home. We want to make sure that you don't owe any taxes to government, so clean CRA with zero taxes due. And that's pretty much it. And your age, really. If you
the older you are, the more...
The older you are, the more equities becomes available to you. Usually, lenders' advertisement is 55 and plus. However, there's a caveat in there. When we say 55, you may realize at the age of 55, you can only get 10% of the equity of your home. So if you already have, let's say, let's put them in the numbers to make it more sense. So let's say you own a home that's worth 500,000. Mm-hmm. If it's, clear from any mortgage, you could probably get, on a basis of 10%, 50,000 available to you.
Okay.
So the higher of the age is, the more of that equity becomes available to you. So yes, from the age of 55, you can look to apply for a reverse mortgage or have a reverse mortgage, but also the amount of equity that you could get would be limited.
So I get that equity. What do I do with that? So
once the equity is out, first thing, the good thing is that it doesn't impact if you're receiving any income benefits, social benefits. It doesn't impact that. So those stays, it doesn't get added as an income to you. And once the funds is available to you, it's entirely up to you. You may want to decide to upgrade your lifestyle. You may decide to invest that into real estate. You may want to decide to, the funds are yours. So you would do what as you see fit, change the car or whatever that may be. So if you wanted to downsize, yep, you could use that equity to buy another house. 100%. And you don't pay mortgages on that, is that? Yes. So let's go back to the concept one more time just to make sure that's clear for everyone. So you get the mortgage, and whatever the interest rate is, which they are usually in line with the market, And that interest gets added to the principal. So you borrow an amount, let's say, again, we're going to go on a basis of a $500,000 property, and you borrow 50% of that as a reverse mortgage, so $250,000. So that $250,000 is the amount that you borrowed. You now have an interest of, let's say, 7.5%. That 7.5% is an annual interest that gets added to the 250,000. So the following year, you owe 255 plus the 7.5%. The year after, you owe 250 plus the 7.5% from previous year plus the 7.5%. So that just continues to add to the mortgage. And that's one of the reasons that the lenders will avoid going above the 50 to 55% loan to value, because they want you to own a stake in the property, and they want you to always, you don't have to move out of the property and sell the property because the loan to value has now reached the point that you owe the entire amount of the house in a mortgage. No, the lender doesn't want you to be in that situation. Hence the reason they put a ceiling of a maximum of 55%, let's say, loan to value is how much you could get as a mortgage. So you always have equity in that home.
Okay. What if I don't have a home? And I'm a first-time buyer, but I'm over,
Okay. If you are looking to buy a house and you are of a certain age that you qualify for the reverse mortgage, that can also work. You don't need to own a home. This can be a vehicle to allow you to purchase a house. Again, with all of the benefits of not having to make a monthly repayments, doesn't impact your cash flow, etc. But it still allows you to become a homeowner. Mm-hmm. That works.
So what is the gamble side of this, and what is the ultimate package side of this?
So the gamble element of it, I wouldn't probably word it as a gamble, but everything's as it is in life has a pros and cons. So the con of this situation is because you don't make a monthly repayment towards this mortgage and the interest gets added to the mortgage, you're giving away the equity of your home for the price of having these funds available to you. However, depending on how you decide to use that funds, you could very much compensate for what you've been giving away for.
Sure.
That said, because again, you don't get to borrow to a maximum of 80% loan to value, 90% loan to value, or whatever that may be, you never give your entire home away, or theoretically you shouldn't give your entire home away to keep this mortgage. These mortgages can be set up just like any traditional mortgages, a 1-year fix, 5-year fix, 10-year fix, whatever that may be. And upon the expiry of the rate, the lender will approach you and say, are you looking to keep the mortgage, or are you looking to pay it off, or you want to renew it for another term? And if whatever you decide, they will act on that accordingly. And when you look at that basis, so let's say in a scenario where you've taken a mortgage over 5 years, because some of the concern could be that, I've had this mortgage for 5 years and now I've given away so much equity in my home. Yes, that's also true. But on the same token, hopefully in the last 5 years, your property has seen some appreciation as well. I mean, we can't deny the fact that over the last 3-4 years, at least what's been happening to this province alone, the property prices have seen a massive appreciation. So even on a healthy environment where we see 2.5-3% appreciation a year on a property, you're still gaining some equity by keeping that assets, and yes, your level of debt is also rising alongside that.
Sure. So when you do purchase a house with the equity that you get, is it your house or is it the lender's house?
No. Well, let's be clear.
And when you sell it,
the house it will never be yours. And I'm going to say that from a technical part. I know this may throw some people off and say, hold on a minute, that's my house. When you're buying a house through traditional mortgage, let's say you put in 20% down payment and the lender puts 80%. So theoretically, 80% of the property belongs to the lender and only 20% belongs to you. So you're always going to be, unless the property is fully cleared of a mortgage, it will never be yours.
Sure.
It always belongs to the lender or whoever holds the majority of the equity. That's the first thing that I would say by definition, that, is the house yours or belongs to the lender? Well, it's just like any other mortgage. Who owns the majority? If you have a mortgage on it, percentage of that house, depending on the amount of the mortgage, belongs to that lender, whoever that lender is. However, I'd like to add something here that's very interesting, and probably a lot of the Canadians may not be familiar with that thing. None of us in reality own our homes. Even if it's clear from any mortgages.
Yeah.
Yes.
We don't own the land.
Exactly. We have been given the right to live in that property. Even if it's clear from any mortgages, it means you don't owe anything on that. But you still only have the right to live at it, and you don't own it 100%.
Well, the beauty of it is that you get extra income and you get deferred payment, let's say. But what happens when you do sell? Or what happens when you pass away? Does it go to your next of kin? Does it go to your wife, your spouse, or the kids?
So the spouse gets to continue to live at the property as if you were still there. But if you decide to sell the property, that's when the debts plus any interest that occurred are due to be paid back. But in an event of death, the spouse gets to live at the property,
Sure.
So the deal continues to go on.
Sure. Let's say you pay it back,
Yes.
and then does the house become yours?
Well, it
You
depends
stay in the house, or does it? The
exactly.
House go?
It depends on how you decide. So the lender would say, "This is how much you owe to us." You may say, "Well, look, just be my lucky day, and we won the lottery. We want to pay it back." Sure, no problem. So you get to keep the house.
Okay.
But most people, presumption is, well, eventually when I pass away, the house will be sold, and the lender could have the money, and whatever is left from the proceeds could go to,
Okay.
the people who's inheriting it,
Okay.
the family.
Okay. So you had mentioned that not many lenders offer this. Who are the lenders that do offer reverse mortgages? And
Yes, so there are 3 lenders predominantly at the moment in Canada that they do reverse mortgages: CHIP, Equitable Bank, and Bloom Financial. These 3 lenders, there may be other lenders as well, but these are 3 lenders that predominantly actively work within the reverse section. There's a new lender called Fraction, also added, but each have their own criteria, their own age group, but mostly the product is the same. It's kind of like having your TD, Scotiabank, RBC. They all have different terms, but ultimately they're all geared to provide the same thing.
Yeah. Are the upfront costs different from the traditional way that you would go?
So the upfront costs are usually the cost of your appraisal.
Yeah.
You will have some legal fees, and that's pretty much it. As well as that, usually most lenders will ask you to do an ILA, which is independent legal advice, as well as a legal fee. So on average, it shouldn't cost you more than $2,500 to $3,000 max as a cost.
Okay. Is there a limit on the house purchase?
No.
No. Okay. Is this something you should think of, like one of the first things you should think of, or is this like the last resort that you should think of, having a reverse mortgage? Should you contemplate downsizing first? Should you contemplate other benefits or other?
Well, it really is going to come down to your personal circumstances and what you prefer. So if your preference is to keep your home because that's your family home, you've had your kids growing up in that house, and you really don't want to say goodbye to that house and sell it, well, the reverse mortgage is there for you.
Yeah.
Or on the flip side, if you say, well, look, I love this house, but it's such a big house, and I'm, finding it difficult to cut the grass, clean the snow, and all of the repairs that's coming from it is just not in me anymore to do it. I'd like to sell it, but also keep some cash available. Well, again, you could sell it, use the funds, proceed to buy another property, or in conjunction with the reverse mortgage, invest the funds and buy another property. So it really is going to come down to the personal circumstances. I wouldn't say is the first or last resort. It's really speak to your mortgage professional about your circumstances and see what will be the best solution for you.
You have had quite a bit of success with this, with your clients. So what is the ideal client? And, maybe you can talk about some successes.
So ideal clients are clients who, from a personal perspective of the clients, they need to have access to funds for whatever reason that may be, and they have equity in the home. Perhaps the property's been paid off over the years, and they could benefit from having these extra funds available to them. They're of the age of 65 and above, preferably, because the higher day of the 60 ladder you are, the more equity you could tap into. Or simply looking to improve a lifestyle, but also knowing that they have this property, that the property itself doesn't generate any income for them, but you could use a reverse mortgage perhaps to invest it wisely, be it in real estate or other investment vehicles to generate the extra income for you.
So just to summarize a little bit, it's got advantages, and it's for a certain type of person who's looking for extra funds or who's looking to downsize, and it's got some disadvantages.
Yes.
Namely, like what I could think of is probably the interest just keeps adding up, and
Yes.
You might not get at the end when the house sells. You might not get what you want from the house because you have to pay back the lender.
Yes.
Is there anything else we haven't talked about that could be like a major drawback or a major positive?
Not in the space of a reverse mortgage. As it is the case, I would say anyone that's interested to find out more about this product, speak to a professional to get as much information as you need. There are information available online, and you could make sure that this is right for you. It's like any other product or services out there. It may be right for you, but it may not necessarily be right for me, and vice versa. It may be right for me and not right for you. So it's all on an individual basis, but you spot on with regards to the pros and cons. Just to recap, you get the lump sum funds, or you could have it in a monthly installment. Doesn't matter. You decide how you want to have it. You don't have to make a repayment for it, so it doesn't impact your cash flow. It doesn't impact if you are in receiving of any social benefits or income benefits or government benefits. It doesn't impact that, and you get to keep your home if you're a homeowner.
Yeah. Well, Milad, thank you so much for taking the time
pleasure.
to talk about this, and very interesting. And
thank you. I hope it's been helpful, and look forward to more of these conversations.
Thank you very much. Bye bye.
Bye bye.